Hey everybody, Eric here. So next up, we're going to jump over to the put side of things and we'll start with the long put. So it's a bearish trade. It gives the holder of the option the right to sell stock. So sell, get it off your hands. Profit for the option is technically unlimited. So as the underlying continues to go down into perpetuity, you make more money. Only note, things can only go to zero. So the unlimited is a theoretical unlimited. Realistically, if you buy a put, best case scenario, something goes to zero, but it can't go below zero, sort of. Futures can, but that's a whole other story. We saw that with crude. Not going to get into that. Um, the max loss is a defined position, so it's the debit you pay. Your break even is going to be the strike price minus the debit you paid. So if you have a 10 strike, you need it to go below that 10 strike at expiration to be profitable. And then let's just run through some market conditions. If the underlying goes up, that's bad for a long put. If the underlying goes down, good for a long put. If IV increases, good for a long put. If IV decreases, bad for a long put. So you can see it's very similar in terms of IV to a long call. So whenever you're long an option, IV expansion helps. It makes the options more expensive, buy low, sell high. So that's why it helps there. And then it's just the inverse in terms of underlying direction. So long calls want it to go up, long puts want it to go down. So as the underlying goes down in price, puts increase in value, which helps this position out. So when we trade these, just like the long call, we typically look for low implied volatility environments because we don't want to pay a lot of premium. And then more importantly, like we're talking about, IV expansion helps long puts. So if you buy while implied volatility is really high, it's harder for volatility to go higher still, harder for your position to appreciate from IV expansion. I personally don't ever trade these, so I'm not an expert in them. And the last piece I'll say is like the order of the trade. This is like a buy low, sell high kind of thing. We want to buy to open the position and then sell when the position's worth more to close for a profit. So let's jump over to the platform real quick just so we can get a quick look at the P&L chart. So this is what it looks like for a long put. As you can see, the further the underlying goes down, the more money we make. And then the further up it goes, we hit our max loss and then we just stay there. And then also, just like any other long option, notice purple line is in the future, blue line is right now. We need the underlying to move in our direction to be profitable. That's really important to know about long options. They are directional plays. And then this gap between the purple and the blue line is at expiration. The gap we see here is time value. So each day that passes, this purple line is going to assimilate to this blue line, which hurts long option holders. So if you buy a put, you're looking for movement, you're looking for it quick so that you can make your money and get out. The longer you stay in, the more theta you're paying. So that's a quick rundown of long puts and what they're for. If anybody has any questions, let me know. Next up will be short puts.